and I'd like to welcome you all as we kick off the afternoon session of day 2 of the 4th Biennial Conference on Auto Lending. This event is sponsored by the Supervisory Research Forum, SURF, and the Consumer Finance Institute, CFI of the Philly Fed. SURF is focused on supervisory issues on retail credit, and Consumer Finance Institute studies credit and payment markets to understand how they affect consumers and households. And this session is open to all this afternoon, and we'll kick things off with a poll in Slido. So if everyone can go to the Slido to see the poll. The question is, the first automobile dealership in the US was established in 1898 by William E. Metzger, and the first woman-owned car dealership was established in 1903 by Rachel Krause. In what year was the first Black-owned car dealership established? And while I give you a chance to answer that poll, I'll give a quick recap of the conference so far for those of you who may just be joining. So we had a great start to the conference so far with over 300 people registered for the conference, and we kicked off the first day of our conference yesterday afternoon. We had some awesome speakers on lending under the COVID-19 environment, as well as auto market updates and outlook over the short and midterm horizons. And we had some really interesting presentations on automation in vehicles and processes and electric vehicle market dynamics after the crisis and longer term. And also the impact of automated underwriting. And we closed out yesterday with some sessions on vehicle purchases by the credit constrained and the state of the used car market. And then this morning we had some closed sessions for regulators only, but now we're kicking off our afternoon sessions, which are open to all. And on the agenda for this afternoon, we have some great presentations on credit score dynamics and discrimination on auto consumers, and then some awesome presentations focusing on competition and consumer welfare and subprime auto buyers. So let's see how you guys did on the Slido poll. Jason, if you could please share your screen. So most of you guys got it. So the correct answer was B, 1923. So in 1923, Homer B. Roberts founded Roberts Motors, the first Black-owned car dealership in the United States. And now I'll pass things off to our moderator for the next session, Larry Santucci. Larry is an advisor and research fellow in the Consumer Finance Institute. Since joining the bank in 2013, Larry has conducted research in consumer credit, the effects of aging on financial security, and historical racism in residential real estate markets. Currently, Larry is examining the effects of household foreclosure on children and their future credit usage. So Larry, take it away.
Thank you very much, Suzanne, and hello, everybody. As Suzanne said, my name is Larry Santucci, and I'm an advisor and research fellow in the Consumer Finance Institute, and I'd like to welcome you to our discussion on credit score dynamics and discrimination in credit markets. Each of the topics our presenters will be discussing are very timely and relevant today, especially as we begin to wade into post-pandemic life. First, the combination of historic enhancements to public assistance and forbearance programs instituted by lenders during the pandemic has had the beneficial consequence of cleaning up consumers' balance sheets and helping them avoid default, resulting in an unprecedented increase in credit scores. Of course, what's good for consumers appears to have become a challenge for lenders, as we heard yesterday. Ethan Dornhelm from FICO, a mainstay of Philly Fed conferences who never disappoints, will speak to us about recent developments in the consumer credit score distribution, as well as some new model developments. Erik Meyer, assistant professor of finance at the Cox School of Business at Southern Methodist University, will discuss his joint work on racial discrimination in the auto loan market. His research interests include financial institutions, household finance, and empirical corporate finance. His recent work studies racial disparities in households' access to credit and the role of credit access in intergenerational economic mobility. Erik, please take it away.
All right, thank you very much to the conference organizers for the opportunity to present here today. I'll be talking about discrimination in auto lending. This paper is joint work with Alex Butler and James Weston from Rice University. And so I don't think it's difficult to motivate a study of discrimination in any setting, but there are a few reasons why it would be particularly important to look at auto lending. So first, auto loans are the most widely used form of installment credit by US households with over 100 million borrowers. This market is also less regulated and less transparent than some other consumer credit markets. For instance, mortgage lenders have to report all the applications they receive, as well as the race and ethnicity of the applicants and their ultimate decisions on those loans. On the other hand, in auto lending, there's not really this systematic reporting of applications or loans. And this could, reduce some of the costs of discriminatory lending practices, and some anecdotal evidence of discrimination combined with this sort of lack of transparency has generated some concern among regulators that there could be discrimination in this market. In particular, the Consumer Financial Protection Bureau issued a bulletin in 2013 that really made it clear to auto lenders that they were going to be held responsible for any discrimination in interest rates. And we'll certainly talk a little bit more about that later. But I'd just like to say, I think we know alarmingly little about the existence or prevalence of discrimination in this market. And so why is that, right? Well, the prior academic, yeah, I was just kind of outlining, I think auto lending is really important to look at in terms of a market where we want to check if there's some discrimination. And we know alarmingly little about it. And the reason for that is really that there's been a lack of serious academic studies on this. These studies are kind of lacking. So Charles, Hurst, and Stevens in AER P&P in 2008 found that Black borrowers were paying higher interest rates than white borrowers. When they estimated it, they estimated a quantile regression and at the 75th percentile of the interest rate distribution, which is typically kind of the subprime borrower. They're finding that Black borrowers are paying 1.34 percentage point higher rates. But unfortunately, they're working kind of with a small sample here from the Survey of Consumer Finances. And these data don't have credit scores, and you can only look at interest rates and not loan approvals or defaults. So it's just difficult to draw really strong inferences from those results. And so, the reason for this is, they're doing absolutely the best that they can, right? It's just that there's a data limitation issue here, which is that lenders have not historically reported application or loan level data to a regulatory body. And so the way that we get around this issue is we construct a novel data set that puts together credit bureau data with Home Mortgage Disclosure Act data. So the credit bureau data, it's a 1% nationally representative panel. It has a rich set of financial variables, right? A lot of stuff that would be really useful for studying auto lending. We can see hard credit checks when they apply for an auto loan. We can see when they take out a new line of credit, credit scores, delinquencies, etc. But this data does not have race or ethnicity, right? So that's where we go to the Home Mortgage Disclosure Act data. It's, covers almost the universe of mortgage lending activity. And importantly, it does have the race and ethnicity of the borrower. Now, these two data sets are both de-identified, but we found that you can actually link originated mortgages between these two data sets based on a set of 6 detailed characteristics that are reported at a really granular level. Things like, the location, the year, the loan amount, etc. And so we can uniquely match, one-to-one match, about 69% of the mortgages in our credit bureau data. And so putting these two data sets together, we now have this credit bureau data set with demographics like race and ethnicity and sex added onto it. And so for this panel of homeowners, we have 79,000 of them, and we're going to go study auto lending from 2005 to 2017. And as we start to think about discrimination, we want to be careful in how we define it. Right? So what we're striving to do is isolate discrimination that's rooted in biased preferences. You can think taste-based discrimination a la Becker, or biased beliefs like stereotypes. And you can think Badalo et al. For this. And the clearest prediction of these biases is that lenders will forego some profitable contracts with minorities, especially at the margin. And so the loans to marginal minority borrowers will be slightly more profitable than loans to the marginal white borrower. And we're going to try to carefully distinguish this from omitted variable biases Here we might be worried that minority status could be correlated with unobservable factors that lower creditworthiness. And we'll also work to distinguish it from statistical discrimination, which is when lenders maximize profits by using race to proxy for information that's unobservable even to them. So this is basically lenders using beliefs about minorities on average as a stand-in for information about the individual. And this is a profit maximizing type of activity, but it is also illegal in the US. So we're going to separate out the discrimination from these omitted variable biases or statistical discrimination. And so when we go to the data, there are typically sort of three approaches that get used when you want to test for discrimination. So first you ask, well, do minorities have lower credit approval rates? In the second approach, you might ask, well, do more minorities pay higher interest rates? And there's a pretty sizable literature on lending discrimination in mortgages. And the vast majority of those papers use one or both of these approaches, and they tend to find some evidence of discrimination in mortgage lending. Right? But there's this underlying concern that there could be, omitted variables that could be contributing to these results that would work in the direction of finding discrimination in these approaches. And that's where this third approach comes in. Here you ask, are loans to marginal minority borrowers more profitable? In practice, we don't directly observe loan profitability, but we can test whether minorities default less, holding, the other terms of the loan constant, right? And this is the closest approximation to the outcome test suggested by Becker, and it's the most stringent test for discrimination, right? And why is that? Well, it's because any omitted variable concerns that might contribute to finding discrimination in approaches 1 or 2 are going to work against you finding discrimination with this third approach, right? Because they would lead to you finding that minorities are defaulting more. Where here, a finding of discrimination is that minorities are defaulting less, right? And so this is going to be a real key in our study, is that we're going to employ all three of these approaches when we go and test for discrimination in auto lending. And when we do that, we find strong evidence of discrimination. So we're finding that minorities pay 1.5, or they face 1.5 percentage point reduction in approval rates. That crowds out about 80,000 loans a year. Minorities pay interest rates that are 70 basis points higher, comparable to compared to comparable white borrowers. And Ceteris paribus, they default less, right? Which suggests that the loans to minorities are slightly more profitable. These results are larger in cases where loan officers are going to have more discretion in the subprime part of the market, and also in states where racial biases are more prevalent, and in areas with less competition among lenders. Right? And this is going to be a real key for us, because competition should root out costly discrimination. On the other hand, it should not root out statistical discrimination. So that's going to be one of the ways that we distinguish our findings from statistical discrimination. And then towards the end of the paper, we get to look at basically the effects of a policy, right? We're going to look at the effects of the CFPB's increased enforcement efforts that started in 2013 and see how that affected racial disparities in interest rates. And we're going to find that it's drastically reduced them. Okay, so first let's look at credit access, right? So here we have this big sample of data, and we're looking at all the borrower years where a person is applying for auto credit, and our outcome variable is an indicator for them being able to take out a new loan, right? And so we're controlling for things like sex, age, income, their credit score, total debt, debt to income ratio, past due debt, characteristics of the zip code, state and year fixed effects, etc. And sort of our baseline result is in column 2, where we're finding about a 1.5 percentage point reduction in approval rates for minorities. In our sample, we're focusing on borrowers that are white, and then minorities are considered Black and or Hispanic. And we're finding pretty similar results for Hispanic versus Black borrowers. And then when we look in columns 4 and 5, we're finding a larger effect in the subprime sample, where there is more of a human component and more discretion involved in lending. When we look at the cross-sectional variation here, it's pretty striking. So here on the y-axis, we're plotting a state-level estimate of what's the reduction in approval rates that minorities face in this state. And we're plotting that against a measure of racial animus at the state level, which is the Google search volume for racial slurs. This is a measure that was just recently vetted in a top economics paper. And so we're finding a very strong correlation here where the states where it looks like there's the most racial animus, where racial biases are the strongest, we're finding the largest reduction in approval rates for minorities. And this is conditional on all the things like credit score, income, etc. When we put this on a map, here we're shading the states, the darkest, where we find the strongest evidence of discrimination. And basically that's in the Deep South, the Ohio River Valley, and parts of the Southwest. And so now when we sort of formalize this cross-sectional variation and look at it in a statistical test, here we're interacting the effect of being a minority applicant with being a high racial bias state, which we're calling the top third in terms of our Google racial animus measure. And we're also able here to look at areas where there's less competition among lenders, measured at the county level here in terms of the HHI of lending. And so what we're seeing is that minority borrowers face a larger reduction in approval rates, much larger in high racial bias states and in areas with less banking competition, which helps us start to separate our findings from a potential statistical discrimination explanation. And next, we're going to take advantage of the breadth of the credit bureau data and conduct a falsification test here using credit card lending data. So credit card lending is essentially entirely automated. They've taken the human component completely out of it, and they're working with a lot of the same sort of hard information that a lot of auto lenders are. And so we're going to look at when the same people who are applying for auto loans, look at them when they apply for credit cards during the same year, right? Either a limit increase or a new card. And we're finding no reduction in approval rates for minorities. So these same borrowers who struggle to get auto loans do not struggle to get credit cards, right? And the cross-sectional patterns also evaporate when you look at credit card lending. So this really suggests that the human component of auto lending and potential biases are driving our findings. Now we're going to switch to looking at from credit access to looking at interest rates, right? And here, we have all the same controls we had before, and we're adding in things like indicators for the loan term, loan amount, loan to income ratios, the share of your debt that's auto debt, etc. Right? And our baseline finding with all the controls in there is in column 2, where we're finding that minorities are paying a 70 basis point higher interest rate. In present value terms, at the time of the origination, if you take the present value of all the additional interest they're paying, it's worth about $410 for the average borrower. This additional interest that they're paying, is much larger in states where there's stronger racial biases, and there's some evidence that it's a little stronger in areas with less banking competition as well. And now we're transitioning to looking at defaults, right? This third toughest test for discrimination, right? It's an approximation of the Becker outcome test, right? Where we're going to look at whether minorities default less, ceteris paribus, right? And the key here is that, if there are any concerns about omitted variable bias in our approval and interest rate tests, you'd have to think that they're sort of working against this test and making it conservative, right? Okay. And so when we look at the data, we find that minorities default less. And this result is strongest in the subprime sample, which makes a lot of sense. Right? So if you think of setting a bar to clear in terms of creditworthiness when you're originating a loan, and if you set that bar just slightly higher for minority applicants, right, you're going to have the most empirical and statistical power to detect that difference in where the bar is set, the closer to the extensive margin of credit provision that you can look, right? And so when we zoom in on these subprime borrowers, we're trying to get as close to the margin as we can, and that's where the result really becomes the strongest, right? And so this is we feel pretty strong evidence of discrimination in lending, but we have to think, are there other loan profitability factors that could explain our results? And we really don't see much evidence of that. So prepayment risk is actually higher for white borrowers. You could think, well, what if there are differences in recovery rates conditional upon default, right? So perhaps minority cars are worth less, or there's differences in usage of the cars. Well, we make an intentionally we're going to do a calibration exercise to sort of understand the magnitude of these potential concerns. And we make the intentionally extreme assumption that, let's say, all white borrowers had a recovery rate of 58% when they defaulted. And let's assume that the recovery rate for minorities is 0%. The cars are literally cannot be repossessed or aren't worth anything. We're being intentionally extreme here. Even under those assumptions, the calibration shows that that type of difference in recovery rates could still not explain the differences we see across racial lines when we're looking at interest rates. Right? And of course, any differences in other loan profitability factors would also have to vary in the cross section. Okay, so now we shift to kind of the quick policy analysis that we do towards the end of this paper. So in 2013, the CFPB really increased its enforcement efforts here. And real quick, there are basically two streams of auto lending. There's direct auto lending, which is when you apply for a loan at a bank or credit union. And then there's indirect lending, which is when you go to the car dealership, the dealership finance officer sends your information out to a lender. That lender responds typically with a sort of minimum interest rate that they would have to charge the borrower. Then the dealership finance officer can go to the borrower and say, you know, the best rate I can offer you is X, where they can mark up the interest rate compared to what the indirect lender was actually quoting, right? And this is called dealer markup, right? And so here the finance officer is basically acting as a quasi loan officer for the indirect lender. So in March of 2013, the CFPB issued a special bulletin warning these indirect lenders that they were liable for any interest rate discrimination that's going on, right? Even though some of it is occurring at the dealerships in the form of markup, right? And the reason for that is that, well, this markup that's happening at the dealerships, the profits from that are being shared with the lenders, right? And the CFPB really backed up this enforcement effort when they fined Ally Bank almost $100 million for discriminatory interest rates. Okay, so we're going to look at the policy, the effects of this policy on racial disparities in auto lending, right? And so here, let's take a look at the left plot. So on the y-axis is the additional interest that's paid by minorities, and this is, you know, conditional on all of our rich set of controls. And we're looking at it each year, and we see that it dropped sharply from 2013 to 14. You know, it was over a percentage point before 2013. Afterwards, it's down below or at about half a percentage point. So an enormous drop in racial disparities in interest rates immediately after the CFPB's efforts here. And this is really, we're looking at the areas of the country where indirect lending is most prominent. If in the right plot, we look at the areas of the country where the markets are tilted more towards bank lending or direct lending, we don't see nearly as large an effect. So this suggests that you know, the CFPB's efforts here really had a direct impact on the racial disparities in interest rates. So overall, we found that, you know, the increased oversight reduced discrimination. It led to a 60% reduction in the additional APR that minorities are being charged, from 84 to 35 basis points. And really importantly, it had no effect on credit approval rates for minorities, which suggests that the additional interest that minorities were paying before this enforcement effort wasn't entirely necessary to make the loans viable, right? Because those loans kept getting made, which is really important from a policy perspective, because a lot of times whenever increased oversight or regulation is considered, there's always a lot of concern that, well, maybe this might actually cut off credit access to the marginal borrowers. And here we're not really seeing evidence of that. And so this is the first analysis of the market-wide impact of the CFPB's initiative. We think it's a really important thing to study, just because this CFPB oversight is controversial. In fact, the bulletin that the CFPB used to spearhead its efforts here is actually repealed in 2018. So we think this is a really important area to study and understand going forward. So thank you so much to the conference organizers.
Thank you, Eric, and I'm glad we could get you back.
Yes, thank you.
Okay, so we do have some time for questions. Let's give me 1 second to pull them up. Okay, I think the first question you have answered and said 80% of auto lending is indirect. Is the discrimination driven by dealerships or lenders? Let's move on to the next one. DTI is considered an imperfect measure due to unverified income in the denominator. How would you address it or reconcile it in the model?
Yeah, so here we are actually using the income that was reported when they took out their mortgage loan. And so that's it's a verified income that you're listing on a mortgage application. So that really helps us, as opposed to using even a really good credit bureau model of income, I think. Yeah.
Right. Okay, we've got a question. It says the outcome test seems to rely only on the frequency of default. Could you compute the loan profitability instead?
Yeah, that would be something we'd love to do, right? We'd love to have a loan level measure of recovery rates, but that's just not in the credit bureau data. But that's where we're really careful to do these calibration exercises to say, so let's say there are some racial differences in recovery rates. Let's assume they're almost unimaginably large, and we show that even that cannot explain the differences in interest rates that we're finding. So that's how we take that on.
There's a question that asks, how would dealers raising car prices in the CFPB enforcement period affect your results?
Yeah, I guess it would certainly depend if they raise it differentially across racial lines, right? So there is some evidence, it's a little dated now, but there's some evidence that minorities actually pay higher prices on their cars as well. Most of that comes from the 90s. So, if minorities are paying higher prices on both the car itself and on the auto loan, that's sort of even more concerning, I would say. Yeah.
Another question is, given that the sample is of homeowners with auto loans, how do you think your findings would extend to the broader market?
Yeah, we've thought a lot about this. And so within our set of homeowners, right, we find much stronger results as we start to look towards lower credit quality borrowers. And so I don't think it's too difficult to extrapolate and say, if we could observe, because homeowners are obviously more creditworthy than the average person, if we could observe even non-homeowners, we'd expect that general pattern to hold. And our results would probably, the magnitudes would get a little bit larger. And certainly some of the estimates of the total national number of loans that aren't approved and things like that would get even a little bit larger if we found larger point estimates in the lower credit quality sample.
Okay, great. Let me just double check, make sure I haven't left anything uncovered. And I think we're good. So thank you very much, Eric. If we